You've done everything right. Maxed out that 401k, saved consistently across your career. Retirement is starting to feel real. So why are some of the most financially prepared people in their 50s still walking into tax traps that they never saw coming? I'm Jordan Drinkhouse. I'm a CFP practitioner. Today we're covering 5 of those traps. Some of them are brand new here in 2026. All of them are fixable, if you catch them in time. Every financial article that you've ever read has probably told you to max out that 401k. Get the match. Lower your taxable income today and let that all grow tax deferred. That advice wasn't wrong, but it was incomplete. Because here's what doesn't get mentioned. When you're 35, you're dutifully checking that box. Every dollar you contribute is a pre-tax dollar. The IRS has a future claim on it, whether you want to give them a part of it or not. They're going to collect it at ordinary rates, not the lower capital gain rates. Now, if you multiply your contributions and the growth over 20 or 30 years, you might be sitting on an account with a lot of zeros. Doesn't fully belong to you. Christine Benz at Morningstar has put a number to it. An account showing $516,000 at retirement can shrink to about $392,000 after taxes. And this doesn't show up on your statements. It shows up on your tax return. Let's layer in timing. By age 75, the IRS is going to require you to pull out money from your pre-tax accounts whether you want to or not. Financial planning researcher Michael Kitces, he modeled what happens to a diligent saver who's got $2 million in those pre-tax accounts. By the time required minimum distributions kick in, the accounts generate nearly $200,000 a year in forced taxable income, pushing people straight back up into the 35% bracket. That's the same bracket they might have been in during their working years. Now, wasn't the promise of a 401k supposed to be that you can pull that money out later at a lower rate? Those distributions are going to stack on top of any Social Security income. So combined, the income makes 85% of your Social Security benefits taxable. And it can also trigger Medicare premium surcharges. We're going to talk about that in a few moments. Michael's also quantified what a smarter account strategy is worth over a lifetime. A couple that directs their contributions based on their actual tax bracket each year, rather than just defaulting to pulling money out of that pre-tax account. They can add over $400,000 in lifetime after-tax wealth. And that was just optimizing for $10,000 a year. If you're maxing out your accounts, that number can actually be bigger. Now we're going to add in one more layer. Currently in a relatively low tax environment. The One Big Beautiful Bill Act was signed into law last July. It made the current tax rates permanent under the existing law. That's genuinely good news if you're worried about taxes in the short term. Long term though, that legislation is projected to add trillions to our federal deficit over the next decade. Nobody can tell you what the tax rates will be 10 years down the road. What I can tell you is that locking in taxes now, rather than deferring everything and hoping that rates stay low forever, that's a strategy that holds up regardless of what Congress does next. So if you're in your 50s, you're in that last real window where you can rebalance this mix. Roth contributions, strategic conversions, building a taxable brokerage account alongside your pre-tax accounts, that gives you options in retirement. Having flexibility is exactly what people need when nobody knows what's going to happen next. Now, if this is how you think about money, subscribe to my channel. It's what I do here every week. Trap 2 is brand new here in 2026. A lot of people are going to get surprised by it around tax time. Now, starting January 1st of this year, if you're 50 or older and you earn more than $145,000 from your employer last year, you no longer get to make those catch-up contributions to your 401k pre-tax. Now let me explain what a catch-up contribution is, because not everybody knows. Once you turn 50, the IRS lets you contribute extra money to that workplace retirement plan above the standard limit. In 2026, your base limit is $24,500. The standard catch-up lets you add another $8,000 on top of that. So that brings the total to $32,500. Now for years, high earners could just take that catch-up as a pre-tax contribution, which is lowering their taxable income today. Not anymore. Under the new rules, if you earned over that threshold, your catch-up contribution must go to a Roth account. You pay the taxes now, not later. In a way, the government just made the decision that Trap 1 said you should consider making yourself. Now, there are two important things to know about this. First, regular contributions up to that $24,500 limit, that can still be pre-taxed. If that's the best for you, it's the catch-up portion that's affected. Now, second, this catches people off guard. If your employer's 401k doesn't offer a Roth option, you might not be able to make catch-up contributions at all in 2026. Those plans are getting rarer and rarer, but they're definitely still out there. Before we get into the mechanics of this one, I want to take a step back here. I want to say something about timing. It applies to a lot in financial planning and honestly everything that we've talked about in this video so far. Tax strategy for people with retirement savings, it's not typically something that's done in a single year. If you have a large pre-tax balance, you want to systematically move that over into a Roth account. You're controlling your future tax bill. You'd be looking at a decade or more of conversions. If you're doing it carefully, doing it right, not jumping up the brackets. It's not a project that you want to start at 68 and finish before RMDs start. It's a project you want to start in your 50s while you still have a long runway to do it right. The reason I'm saying this here is because the trap we're about to cover, it's one of the clearest examples of how a decision you make today, years before you retire, can create financial consequences that you don't see until it's too late to undo them. This trap, it operates on a delay. It's part of what makes it complex for people to plan for. Now, Medicare charges most people a standard monthly premium for their Part B coverage. In 2026, that number is $202.90 per month. Reasonable enough. But if your income crosses a threshold, Medicare is going to add a surcharge right on top. It's called IRMA. It stands for Income Related Monthly Adjustment Amount. Now, everybody needs another acronym like they need a hole in the head. And the government loves to give us new acronyms. In 2026, that surcharge, it kicks in at $109,000 for a single filer, $218,000 for a married couple. And it's not gradual. These operate on a cliff. If you just go $1 over that threshold, your premium can jump up by over $1,000 per person. Medicare looks 2 years back to determine your surcharge. So in 2026, that premium would be based on the 2024 income you generated. Remember what I said earlier about Roth conversions? They take years to execute properly. That timeline and this 2-year look back are directly connected. If you wait until you're 63 to start moving money out of your pre-tax accounts, you're doing two things at once. You're compressing that multi-year window into a much shorter window. It forces you to take larger conversions each year. Those larger conversions are exactly the kind of thing that spike your income and cause you to cross an IRMA threshold right as you're entering Medicare. The decisions you make in your 50s, while you still have a long runway to spread out those conversions, keep your income below the thresholds where the cliffs jump up for Medicare premiums, are what determine whether your Medicare premiums are manageable in retirement, or you're going to be opening a letter from the Social Security office wondering why your healthcare costs just jumped up. Now, this next trap, it's not a trap in the traditional sense, but it is a brand new opportunity that most people weren't ready to take advantage of. The new law created something called a super catch-up. It only applies to people who are 60 to 63 years old. Now, if you fall in that age range, you have a 401k or similar plan through your work, you can now contribute $11,250 on top of the base limit in 2026, instead of the standard $8,000 catch-up available to everybody else over 50. So that brings your total potential contribution to $34,750. But the moment you turn 64, that's gone. Drops right back down to that standard catch-up limit. Now, 4 years, that's the window. If you're still in your 50s, you actually have time to prepare for it. Most people didn't know this was coming. That means you're looking at your cash flow, you're checking your savings rate, and how your overall financial picture is structured. That way, when you cross into that 60 to 63 window, you're in position to take full advantage of it, rather than, watching it pass you by. because you didn't have the money prepared to contribute to your retirement. 4 years, that's your window. If you're between 60 and 63 right now, this is a moment. You can look at your cash flow. Ask yourself, should you or can you redirect more towards your retirement accounts? The tax benefit you get, the compounding potential over the next decades, it can be significant. Now this last trap, it can be devastating for families. It does come with a simple fix though. It's just some paperwork. I know, everybody's favorite. The beneficiary designations on your retirement accounts, like your 401k, your IRA, or even your life insurance policies, those override everything else in your estate. They come first. They override your will, they override a verbal agreement you made, and they certainly override what your spouse thinks should happen. If you name someone as your beneficiary on your IRA 20 years ago and your life has changed since then, it could be a divorce, it could be a second marriage, maybe it was the death of the original beneficiary. That old beneficiary designation, it can still control where your account goes when you pass away. There's a newer wrinkle to this worth understanding. Under the new Secure Act, most non-spouse beneficiaries who inherit a retirement account are now required to empty that account within 10 years. So if your adult children inherit a pre-tax account and they're earning the most money they ever had, they have to withdraw that account at the highest tax rates they've ever been subjected to. Now the fix here is simple, it costs you nothing. Pull up your retirement accounts, confirm who's the beneficiary, look at the primary and contingent. Make sure that still reflects what you want to happen. It's about a 20-minute project and it can protect years of your savings. Getting the names right, that's only the first step. Once you know who's inheriting what, the next conversation to have with an advisor is how to position those assets so the transfer is as tax efficient as possible for the people who are receiving them. It can be a gift to them. Who inherits a Roth versus who inherits a traditional account in what amounts can make a significant difference in what they get to keep and what they have to give to Uncle Sam. 5 traps, all of them fixable, most of them invisible till someone points them out to you. Now, if you're in your 50s now, any of these hit home for you, that's actually a good sign. It means you are paying attention right at the moment when it still matters. If you want help running through how these apply to your specific situation, a link to my calendar is in the description below. And if you found this video useful, share it with someone who could use a heads up. The best time to deal with these, it's before they become a problem. Thanks so much for watching. I'll see you in the next one.